advice warning. The content presented in this presentation is intended for informational purposes only and provides general advice only. It does not take into account your personal objectives, financial situation, or specific needs. This information should not be the sole resource when making investment decisions. We strongly recommend you seek the advice of a financial professional. Hi everyone, welcome to this week's edition of Bulls versus Bears, the weekend edition. Welcome to Kai Chen, JT away this week. Out on the yacht as per usual. But at least there'll be some intelligence here somewhere in the podcast. You've been moonlighting on the Global Alpha podcast,
Yes.
speaking far more interesting stocks than
Young Mr. Nader.
Young Mr. Nader. Yes, never a dull moment with the young man. So obviously we're entitled this week, EP82 is tech stalls as seasonal weakness begins, or beckons, sorry. Not begins, hopefully begins. But pretty good week for the ASX overall. We had earnings season, and despite the fact that we had James Hardie and CSL get really belted, which are two fairly large parts of the index. And we still managed to crack 9,000, the big nine. The first time we've had a 9 on the front of the on the front of the front number. So, but all the while though, what makes it even better is Hang Seng down 1.6, S&P down 1.5, Nasdaq down 3. The Dow finished flat basically, but we'll see in the heat maps coming up. There's a massive rotation out of big tech this week, and in doing the morning podcast, Kai, there was an MIT study that came out this week, overnight, which really did play into the tech fears. And the study basically said that 95% of companies that they did the survey and the study on, are not actually making any money. In fact, a lot of them are losing on AI. And it raised concerns about the monetization part. And I mean, obviously, when you're talking 95%, you're not talking in terms of market cap, are you? No. That really probably echoes that Russell, for instance, this year has been underperforming, and it's really those massive mega caps that have been doing really well. Is the first people, the hyperscalers as they're calling them now. But yeah, pretty interesting to come. Like MIT's like the Harvard of.
Well, they're much more tech savvy. Most of the graduates from there are either scientists or data scientists, physicists.
Yeah, they're like pure mathematicians, stuff like that. So so they definitely know what they're talking about.
I think I am surprised in terms of, obviously there's been mass adoption of AI, as we see, from day-to-day use. It's widely available now, and I think the base language models are starting to reach a bit of maturity because, we're seeing it in a lot of use cases, and we were chatting about this the other day in terms of vibe coding. The things that it allows you to do is quite amazing, but I think when we talk about from the monetization side for the companies, it's interesting because I think they are, although I think they're still not monetizing very well, I think they are starting to do that, right? As you can see with all the large language models.
And I mean, how do you define monetizing, right? So, like for us, we run a very lean team, but we probably get the work done of having 10 extra bodies in the room. So, but you can't show that on a balance sheet, can you? That's not effectively monetizing, but its efficiency is a form of an intangible cost win. So, we've always sort of said that companies will use it to reduce costs initially, and then probably monetize later. So, I suppose it's a scary headline, I suppose, and markets quite often don't dig deep enough into it. But you don't show those cost savings on the balance sheet. And I think even in earnings, actually, this time, there was the misses were in revenue, but the EPS, the earnings per share, beat on a much higher rate than revenues. So that, I mean, now thinking about it, that probably is they're probably gaining efficiencies, but not necessarily monetizing in terms of revenue generation. So
because we've got to bear in mind that basically, again, going back to that analogy, they're building out the base infrastructure, right? They're commoditizing intelligence at the moment. So there's not much high end product yet. Like for example, if we go back to the internet example, these guys are all making it's like broadband. They're making they're doing the network, they're doing all the raw compute power and stuff like that. But there's no real big end product, right? Because it's very very early in the stage, right? Like you can see it kind of forming where these vibe coding tools or website builders that are using AI and stuff. It's you can see it, but it's not mature as a product yet. And I think that's really where that end product you're going to see higher value, right? Because like imagine, for example, if you could just type something in your computer and say, build me this website, and builds it in an hour, complete end to end, right? That's something that people will pay money for because there's a business case for it where people are willing to pay thousands of dollars to get that solution. But I think in the raw form, it's a commodity, right? Because you're basically buying compute power at the moment. So I don't think it's going to be for the next couple of years until we see something that's a bit more polished.
Well, yeah. Well, I mean, we've been knee deep this week in we've done a structured investment around hyperscaling AI, but it's really around the rapid expansion of data centers. To be honest, the resources needed around it, the things that you'll need, not just your Nvidia or your Blackwell chips, but power management, power supply, the copper and water, which are two. You need to wire it and you need to cool it. And there's a lot that goes into it to build this out overall, and that infrastructure build, that picks and shovels, is always in every industry is always the first thing to gain the benefit. And but I mean, normally we start with what we did in the media this week. I did the call at late notice. JT did the trade. We've had an extraordinarily busy week, so we won't bore you with all that realistically. There wasn't too many. I mean, the only highlight I did from the call, but the call was on an hour's notice, so I wouldn't say it was my best work. But one thing that we picked up was WiseTech's reporting next week, and in Australia, and at these prices, it got from myself and Howard Coleman from Team Invest. Look, Howard Coleman's pretty bearish on everything all the time. They're very much of the ilk that they have 20 stocks and they sit on them forever. But WiseTech's one has been a wealth winner, as he puts it, for a long time. But we both said it was overpriced and gave it an overwhelming sell. And usually I'm the bear on these shows, but he was like, this thing could pull back 50%. If CSL can pull back 16% in a day, WiseTech misses, because that's been the pattern in the Aussie market this week particularly. If you miss by a little bit or do anything unpredictable or that wasn't expected, or CSL actually kind of beat on most expectations, and for it to that's its worst day including the April Liberation Day and everything, and they we put it through 3 AI models in the morning and to double check our work. 16% was ludicrous and traded 52-week low. But I was of the same opinion of him on CSL. Is like our clients and his members, we're like, giddy up. Like, we're happy to get a great company at a cheap price. Whereas everyone else, the amount of people, it's been so funny. The amount of people that have come out of the woodwork this week and gone, oh, I've always said CSL's. It's like, no, you haven't. You've never said that. That is absolute crap. So the media pundits and the analysts and commentary this week has just been like, I think Harry Hindsight is the best way to put it. Like they're retrofitting an argument into the market's move rather than actually being analysts and looking at the fundamentals. It's just I'm so quickly losing just drastic faith in the Aussie market. I think we've just become an ETF an ETF and passive flow market, and because look, JB Hi-Fi got belted. Wesfarmers hasn't even reported yet, and they're now trading at higher multiples than the Mag 7. We're talking about an electronics retailer, and Bunnings is trading at a more expensive multiple than Nvidia and Microsoft. Come on, it's ridiculous.
It's interesting. I think that sometimes these stocks get such a premium where when they're the market darling or they go for a run, the market prices in continued expectations in terms of their growth. Right, so they go, okay, well, look, they're going to continue to replicate this at this rate of growth, and that's what causes that shock because they go, oh, hold on a second, it's not as good as we expected, even though it's still good. It's not as good as we expected, and then they get absolutely punished because everyone's along that as well, right? So
yeah,
it's kind of a feedback loop where with that high expectation, if it misses, it gets really punished because everyone's heading for the next door. So
yeah, I mean, look, even I think JB Hi-Fi missed slightly and their CEO resigned and it got hit and then the passive flow just came back in and then it just made a new record high. I'm not saying the company's a bad company. I'm saying the company is a fantastic company. What the market's paying for it is just absolutely silly. So, and yeah, like I said, James Hardy missed by 15%. The US home builders have been doing quite well and there's a shortage of homes in the US. Similar to Australia, probably maybe even slightly worse. And they got hit nearly 40% from where they opened. Like they were hit 30% the first day and 8 the next. They bounced back a little bit. And then, Telix reported there was nothing new in it. It opened down 2%. And then they finally found some buyers. And it's just, there's been some weird moves. Which brings us to the main feature story on the front page of the Weekender is just this, is tech, is this tech stall a red flag in, and look, I quite often talk about season, and I have talked on this podcast on a number of occasions on seasonal weakness, but for those of you, I should have done a slide on it, but I won't. But I'm going to go through. I'm going to go through like the Schiller Cape, which is the average PE ratio over 10 years, which is one of Buffett's favourite indicators for undervalued or overvalued. It currently sits at 38, and the historical mean's like 22. So it's overvalued. Trailing PE overvalued by, it's 26.8. Usually it's at 20. The Buffett indicator, which is the market cap to GDP, the current value is 207% market cap of the stock market to GDP of the US economy. It usually sits at 150%. That's severely overvalued. That's like screaming. Tobin's Q, it's hard to explain that one. Price to book is at 4-1 in the S&P 500, normally sits at 3. Dividend yields at 1.4, normally sits above 2. Price to sales is normally 2. It's normally 2, is currently 3. And then margin debt on the NYSE, so that's leverage to buy stocks, is at near record highs. So that's another massive one, and that's leading into the only month of the year that is, I think, on a 56% basis, it averages down 0.7% in September. And it's the only month that it actually is down more than it's up. The rest of the year, it averages up. And we did sell a short hedge with our structured investment this week, so we did a lot of statistical studies, and something that JT and I touched on last week was the market moves really fast these days. So since 2009, when the GFC happened, if the market had a significant pullback, it would take something like 500 to 1,000 days to get back to break even or make a new record high. The last So we've had 5 large falls of since 2015. So 16% in 2015, 20% in 2018, 34 in COVID, 28 in 2022, and this is the S&P, by the way. And then we got obviously a 21% so the average large fall in the last 10 years has been 21%. It has only taken 127 days for the market to bounce back to break even, under 4 months. Liberation Day is the only one that's actually busted through to new records. We're now nearly 30% from the low in April, but like that's less than 4 months. So it's around about 4 months. Sorry, compared to what used to be 18 to 24 months. So the market now, we don't go sideways anymore. We either overextend to the upside or overextend to the downside, but we do it very fast and we turn the ship around very fast. So we're a little bit concerned at the moment with all those overvaluations that, hence we've done a hedge. And look, even falling back into the middle of the range is a down 15% move. And I think that, with things like margin debt at record highs and people thinking that like the first rate cut as well, the average 3-month return of the stock market after the first rate cut is down 16% as well. And we're 99% sure we're getting a rate cut next month. But then obviously then when the stock market goes, it usually follows with more and more rate cuts. And that's what Trump wants. So, and he's put a guy in the Bureau of Labour and Statistics to get the numbers down, and he'll go and refinance that debt down 2%. So I reckon rates are going to move quickly, and then that's where you get that swift bounce out. So, look, there's a lot of things and a lot of statistics lining up at the moment. The market seems pretty complacent, but yeah, thank God for AI. Where's the MIT guys on that one? Because for me to collate all those stats 3 years ago I'd still be working it out for the next 2 weeks. There's no way I could have done that. We're a little bit concerned and heading back to cash, but you can kind of see, I'm going to go quickly to, you can see this rotation happening in the US stock market here now, where those frothy US mega cap stocks, whereas the rest of the market here, the healthcare is very defensive, financials are relatively defensive, consumer staples is defensive, and healthcare here as well. United Health, another good week there overall. So since Warren Buffett stepped in and upped his stake a week ago, I think that'd be about nearly 20% in 2 weeks now. But just going quickly back to the Aussie market, as you can see, the banks, there's all your passive flow there, and your Wesfarmers and your Telstra. Transurban and Brambles did pretty well. Brambles did great, reported really well. But your WiseTechs, your Pro Medicus, your cyclicals are all, and surprised Goodman Group actually performed really well, beat all expectations, but ended up down 5%. But you can see that cyclical nature part of the market is getting a little bit hit, and then the passive flow part of the market just keeps on attracting that money. So which brings us next week, which is really only one company that we need to be worried about, to be brutally honest, and that's Nvidia on Wednesday night. Thursday morning, it's the last of the Mag 7, and then we're done for US earnings season completely. So I think that'll be the big show next week. And I haven't had time to do the calendar. We've been a little bit too busy for Australia. I'll probably do it over the weekend. But you got Wesfarmers, Fortescue, Woolworths, WiseTech, Coles, Santos, Qantas, Linus, NextDC, Reece, which everyone will be a bit worried about given the James Hardie result, and Ramsay Healthcare. So
Fortescue will be an interesting one to see next week. I mean, it's had a bit of strength over the last month and a half or so.
Yeah.
I think the recovery story in China is both lithium and as well as iron ore has seen a bit more strength compared to the last half year period, which is good. So
we've been waiting 4 years for the property China market to bounce back. But if it does bounce back, like imagine the competition for some of these data center construction is this month there's more data center construction than there is office construction in the US now. But if you've got the energy transition data centers and the Chinese property market competing for steel and copper, I mean, that's a pretty perfect storm, I would have thought, potentially. And no one's talking about the China story. But reducing those restrictions on property ownership, I think, is I don't know the rules but specifically, but you weren't allowed to own two properties within the same radius. So you were restricted, and then I think they halved the deposit rate that you need to get a house as well. So they're pretty loose policies. So we might start to see them head higher. The analysts always hate Fortescue, so it will be, but they'll still probably find an excuse to sell it anyway. I don't know why the analysts hate Fortescue so much. Maybe it's Twiggy, but who knows? But yeah, the consensus is always the price target is always like 10% worse than what it should be. So I guess we'll see. But I mean, they make pretty good margins. What was it, 86%? Did you work out?
Yeah.
I mean, pretty good overall. And they've all of their fleet's gone to electric and not automated, but the drivers now don't sit in the trucks anymore. They sit in an office somewhere, and they're remote control. Yeah. So
the farmers and the miners, they're in the offices controlling the robotics.
Like I said, John Deere's a data science company that just happens to have tractors. It's pretty amazing what that efficiency. But we don't seem to have seen any job losses from it yet, despite everyone announcing job losses. So this will be it'll be Friday week, the next payrolls. And that could be a scary number, I reckon, overall. So yeah, Tesla was down, but the retailers as well, the big, what they call the big box retailers, Amazon, Home Depot, Costco, Walmart, Lowe's, Target, and those guys, they all got walloped this week, and they only reported kind of last night. So, and they were up for the day. So that red's really a lot worse, to be honest. And a lot of analysts regard that as more reliable data than retail sales, because they are the most efficient retailers, and if they're struggling, then look out, sort of thing. So yeah, and there was no announcements in the healthcare sector. But I think that flow back into the healthcare is because it's been hit a little bit. I think Warren buying some United Health stabilised those ETFs a bit as well, and I think that's just a switch to the defensive there. And I don't know what happened in Tesla, but I think it's had a good couple of weeks. So there's been for a change, no news there actually. Elon hasn't said anything offensive all week, or he hasn't picked a fight with someone or announced something new. So yeah, well, and commodities were super quiet. I mean, look at the weekly changes are basically nothing overall. I mean, we had a bit of movement in uranium, but yeah, I think they've done pretty well with the US dollar up 0.4 for these guys to be slightly up on the week or flat. It's not a bad result. But with JT not being in, he normally does the commodities part. I struggled to find any news in commodities, so I just covered 3 this week on the weekend report, but there wasn't much there. I mean, 4.5% for Bitcoin's like Tuesday, and I think 4% in uranium's pretty low as well. So coal's done okay, but yeah, like nothing much to talk about there, to be honest. So trade of the week, that was last week's trade of the week. 10-cent music, but we'll have to talk about this one. I've made a bit of an error with the slides with Palo Alto, which reported, and I think it rallied about 5% on 5% on earnings. Nader recommended it the Friday before, and headed up. What was the investment thesis there with Palo Alto?
I think just good reportings and basically their earnings continue to increase, right? So it's
and they're in the cybersecurity space, right?
Yeah, correct.
I don't know much about them, but yeah.
I mean they've done incredibly well, and I mean in general the cybersecurity space over the last year, it's gone on a bit of a tear. So most of the companies in that sector have actually outperformed by quite a lot. I think it's like the ETF was even up like almost 50% over that 1 year, right? So,
yeah, wow, okay.
Yeah.
So yeah, we started to dig around in it a little bit, and Fortinet was another one that you really liked, wasn't it?
Yeah, they do. They do like the custom hardware solutions for firewalls. It's a mix between hardware as well as defense software. So obviously with cyber security being a lot more on the forefront these days, being attacked as well as people using AI to do a bit more spamming and stuff, and we've been actually a victim of that lately.
Yes, yeah, no, we had our emails shut down because someone they entered 990 separate emails into our. I'm sitting there going, "Geez, someone's really interested in this article," and then we just had to delete the. But we couldn't it shut down our email. We got flagged for spam. We had to call Microsoft. And that was just but now I always used to think, what is this stupid I am a human box that you've got to tick all the time? Now I know what that box is for.
It's useful.
It is very useful, and I will click it with a smile now, knowing what it's for. And oh God, I got to say, I used to pride myself in being quite tech savvy, but the older I get, I'm just like, oh my Lord, I'm losing it. But yeah, one of the hard things about the cybersecurity space as well, which we found, because we did have a bit of a brainstorm session on it at one stage a few weeks ago, or about a month ago or something, was because I tried to look into it and how much we tried to find one that was doing defence, cybersecurity for the Department of Defence, and they're actually, because it's national, it's classified. You can reverse engineer how much revenue they get, but they don't. But they're actually not allowed to specify what their contracts are for. So it does make the earnings a little bit difficult because you don't necessarily know where it's coming from, because you don't want to give any clues to the hackers as to what what specific projects I guess they're working on. So it was. I kept on looking for it. A defence-based cybersecurity firm, and Palo Alto does it, and as does Palantir particularly, and also and Fortinet, but but none of them are allowed to say how much and what. So the contract might be 10 billion over 10 years, and they might be getting drip fed it, but they're not allowed to specify. So, well, in some cases they're not allowed to specify. Obviously, they can. They can give out broad details sometimes or whatever, but it does make it a little bit hard to price something when you don't know how much money's coming in. On it, but yeah, it's a pretty. I mean, that's what you're gonna. If Die Hard 4 taught us anything, Kai, that's that's the first thing you need to attack, isn't it? So, for those who haven't seen Die Hard 4, top movie, you should go and watch it. It'll scare the crap out of you, and you want to buy cybersecurity stocks probably.
I guess the other trade we want to talk about is that the short trade, right? So basically, us buying insurance on the market this week, and we were quite surprised when we got the pricing back. And for the viewers who haven't seen it, basically, it's about, you pay $3,000 up front to insure
$3,300 for $100,000 short.
Yes. So if it passes, if the index base, if the S&P 500 goes down 3.3%, everything above that is like 30 times. So it's crazy. Like, I mean, to get that risk to reward is just, it's stellar.
Well, yeah. I mean, JT made a great example. So JT still, he said I'm bullish, but I'm still recommending my clients buy this because it's a 2-horse race. September is more than 50% a down month. And we've got this on a 3-month basis, by the way, so it's a short-term hedge. But as we saw with those statistics about how quickly it bounces, to be honest, we would have gone 2 months if we could get it. Because it bounces too fast and you're kind of locked into this thing. So, and early exit involves penalties and all sorts of crap. But what we will do is buy stock, but it'll enable us to buy stock more aggressively and buy the dip. So we won't necessarily want to get out of it. I think what it does for us is it frees us up to know that we're covered to the downside if something continues to happen. But it was cheaper. Yeah, cheaper than car insurance. And if you think about it, $100,000 car, you probably wouldn't. You'd probably be paying about $3,500 in insurance on a $100,000 car. And you're getting or another example he gave is it's 33-1 odds on a 2-horse race. So I mean, look, if the market is flat or up by November, you don't get that cash back. It's a binary thing. But I mean, it's only 3% of the notional, so it's much better than it's saving us having to do really difficult trades like those short ETFs where you generally do the US, but you can't get out of them when the US is open. When the US, so you get stuck with them sometimes, and they gap, and you leave them on too long, and et cetera, et cetera, et cetera. So,
I mean, just cheaper risk to reward as well, right? So, I mean, your downside's limited. It's only limited to what you put up.
Yeah.
Whereas those shorts, it's a lot harder to manage. Where, if, say, for example, the S&P goes on another rally for another 6 to 10%, if that was the case, you'd have to cut it really early. There's no space for that trade to work out. Whereas, if we're right, then that's a massive reward if we get that right.
Well, and even if we're wrong, we've paid away 3% or 3.3% effectively to have peace of mind in what is seasonally the worst period of the year. So, but the reason it was so cheap is because volatility, the VIX has been. So we locked this in during the week and pre-hedged it. But VIX has been at 18-month lows, basically, at 14. So it's drifted a little bit higher towards the end of the week. But yeah, it was, which is why that market volatility has probably gone back to neutral there, because I think it's back at 16 or 17 now. It rallied 5 or 10% last night. But earlier that's where we've priced that up before, and when vol's above 20, that it costs about $11,000 for that same exposure. And being a binary strategy, that's not $11,000 or 11% is a lot to lose. Whereas 3, you can kind of cop 3. Particularly, that's why we sort of described it as insurance more than anything else, because if your house doesn't burn down, i.e. the equity market, you don't get your money back. But if the house does burn down, you'd be very, very happy you paid that $3,000. So, and just so we're at neutral in the fear and greed index. I was bullish last week. JT was bullish as well. We were both wrong, but we were only 1-star bulls. So it's been a while since you've been on, Kai. So we're giving a star rating of how bearish and bullish we are.
Is this out of 5 stars or what?
Mate, it's out of 5. It's out of 5 stars. It's always out of 5 stars. But it's only because we've been, being bullish or bearish is a pretty broad statement. Like I thought this month I didn't have any conviction either way. I thought it was going to just drift a little bit higher and then we and not do a hell of a lot. So I've been a 1-star bull for like the last month. And I think, well, since July, since the week of July, actually, and the market's up 8% since then. So, but I'm going to be a one star bear this week. But coming into, well, actually, maybe I might go a 2-star bear. It does look a little bit vulnerable, but it always seems to have that one last annoying push. And Nvidia, I think, is going to have a good result, and it might save the market. So, I mean, if I'm, I'm just preparing, because next week I'm going to pre-lodge, because we're going to record this in the day before payrolls. I'm going to be an 8-star bear. Like I may even wear a bear costume on the podcast next week. It is, for me, it is so done. And I don't think, everyone keeps going to me, oh, you can't drop 20%. I said, well, it's rallied 30 since April. So even if it gives back like half of this, is going to be like at least 13 or 13%. And we don't do 13% moves anymore. We always have Volmageddon. So, once you slip through that 10% mark, it always nearly goes to 20 nearly every time, because everyone's so bloody leveraged these days. But what about you, mate? What's your?
I was going to go 3-star bear.
Yeah, I want to be, but I've got a funny feeling Nvidia will provide a catalyst for everyone to get sucked into that last trade. And I
think it's done that too many times. I don't know. The market might just call the bluff, right? Because I mean, it's how many times has Nvidia saved the market over the last year?
I think pretty much like all the time, basically. I mean, it's and someone pointed out this week that because we did a hyperscaling AI strategy, but we put this hedge in it because we were concerned, because the strategy for hyperscaling AI is 2 years. But we're taking advantage of vol being cheap, so we got really high leverage on that. But we obviously we put in the hedge because we're worried about a short-term downturn. Yep. We did defense stocks as well, and hedge those as well. I'm confident in those two thematics, but I just kind of get the feeling it'll, we've had 5 days in a row down, and I can't remember the last time we had 5 straight days down. This market just always seems to have that that final little squeeze to get the bear, to shake out a few bears before it actually goes. So we've got Jackson Hole this weekend as well. So I reckon there's going to be a lot of people politicking they all know there's going to be a new Fed president in May, and Donald Trump's appointing them. So that you wait and see. That part of your job interview is going to be saying how much the economy needs rate cuts is going to be all this weekend. But I'd love to see Jerome Powell get drunk and just say what he really thinks, because he knows he's gone. So, and this is his last Jackson Hole. Like maybe someone roofies him or something, and we're
doing 8 rate cuts.
Yeah, we're not. No. Powell can't save himself. He's like, we're not cutting. It's higher for longer. Like that'll rattle the market hard. But I expect there to be a lot of bold statements, because Trump's basically, he's making this an interview process. He said, I've got 11 people in mind, and I guarantee you it'll be like whoever's the most dovish gets the job. And I think someone else has stepped down from the Fed as well to miraculously make way for another one of Trump's stooges. And then Trump's got his guy who was in the Capitol riots now on the going to be running the Bureau of Labour and Statistics. He hasn't been confirmed yet. However, I think Trump's made his message pretty clear to the people at the Bureau of Labour and Statistics. If you want to keep your job, make sure the numbers don't look good. So because they, the only thing that moves the needle on that tragic debt is rates lower. So yeah, it'll be interesting to say the least. I would expect some of the jobless numbers are starting to look a little bit weaker as well. But another little precursor, junk bond demand, credit spreads hit their lowest point since 1998 this week, and that means that the system is competing way too hard for like crappy debt, essentially. The difference between crappy debt like junk bonds and government bonds is at the narrowest level, and it quite often does that prior. And if those spreads widen quickly, that is one of it is the single most reliable bear market trigger. So we're going to have a very, very close eye on any movement in those spreads. I set up sort of some alerts this week, and but that that just sort of proves there's too much silly money floating around. And we've got a Kramer of the week this week. Jim Cramer's back. He's been on fire lately because he's been long Palantir and he's been long Nvidia. And I actually I defended him on Twitter the other day. I'm like, leave the guy alone. He's actually nailed it on a few stocks as well. But he stopped the momentum in Palantir. He called it. He said this thing's going to open at $200, and literally within the hour it nosedived 15%. And then he's called Bitcoin to zero in the next 5 years. So Jim's back. He's back to his old tricks. So and look, and just, a general Kramer I think the Kramer of the year is going to go to ASX analysts. I'm going to call that early. It's only August, but I think those guys are doing such a terrible job these days that, even GPT's doing a better job. I don't know what the hell these guys are on, or whether they're even there. I don't even know what they're doing. But this earnings season has just been scary bad from the analysts. Like the company's beating and then getting flogged 16% when it's your largest healthcare company. That means that funds and analysts they're asleep at the wheel in Australia. So, and active fund managers, well, God, you wouldn't want to be an active fund manager at the moment. So you're short CBA, you're probably overweight CSL, and you're short and you're underweight Pro Medicus. It's not been a fun year for the poor old active fund managers. So, which there was a big AFR article about. But I think it'd be interesting to see if something comes out of Jackson Hole. I think there'll be a lot of rate cut talk, which maybe which could see a little bit of buoyancy next week. But yeah, so. Whilst I shouldn't be bearish, I'm gonna start warming up for next week. I'm gonna go get the bear suit out of dry cleaning, and leading into that payrolls. So but thanks for joining us, Kai. We'll have to get you back in more often. But the only problem is I don't know how to do three people in the same podcast. So, but yeah, well, thanks for everyone for listening, and we'll chat again next week.
Thank you.